Hey, everybody. Hope everyone's doing wonderfully well. This is me, Gareth Soloway. I decided to go live for the Federal Reserve decision today. So I am here with you guys. I'm in my cockpit of trading here where, believe it or not, I may actually make some live trades while this is going on, depending on if the price action is good enough and the levels do get hit. So my goal here today, guys, is to walk you guys through the Fed decision. I'm going to listen in live as we get that decision and see what it is. I want to watch the market's reaction, right? So if we flip over to some chart action here, let's do that right now. This is the S&P 500, right? So basically what we're seeing, we had a little bit of a gap up today, and we are seeing a little bit of a drop down, but we're still net positive for the day. If we look at the intraday 10-minute chart, this is the price action. We started here, we kind of slowly faded. We then slowly moved up and we went down. Essentially, what that's showing us is almost no movement during the day. It has been a very quiet day. Volume on the S&P 500 is minuscule, but it should pick up dramatically into this decision or when this decision hits. Now, the decision, again, is about 14 minutes away. So let's go through the different charts. I want to look at the chart of the S&P here. What is the bigger picture telling us? What ultimately do we expect? The dollar chart, the 10-year yield chart, gold, crypto. We'll go through it all step by step into the decision. And then when the decision hits, get ready because, again, we may have to see. Now, I do want to, basically my goal today is to bring you guys maximum alpha. And I do want to welcome Mike McGlone to the trading floor here, or my trading floor. How you doing, Mike?
I'm good. It's great to be on your trading floor. I miss being on trading floors.
Well, it's good. I'm glad. It was kind of last minute where I threw this together, but I was thinking, who else could be on here that would help dissect the Fed decision today and look at the price action? I just said Mike would be a great choice here. So basically what I wanted to do here is go into a few little charts, taking a look at it. I'd love your feedback on some of these charts as well. But if we take a look, let's just go right into the S&P 500. So my chart on the S&P anyways, what I have here is we were making this wedge pattern. And recently we broke down. And that's obviously a bearish scenario. Now, I think, Mike, you would agree that just because we broke down doesn't mean we'll go down on the Fed decision, but it's more of a bigger picture scenario, right?
Can you, Gareth, do you have the ability to click that to I see daily, click it to a weekly?
Yes, absolutely.
I want to show you because the lesson I learned on weekly markets and is I can get much better signals on weeklies. See the pattern before this week? It was basically 3 weeks in a row really stuck in a range and seems to be breaking down similar. I find that I am less likely to lose my hair with weeklies, because I guess you might be more of a day trader. Look at the macro. That to me is the breakdown, but it's always like, okay, and you look at it, yeah, it's technical, maybe it gets the bottom range, but is there a good reason? Bottom line is we see the Fed's not going to be easing. They're going to be hawkish today, guaranteed. I just look at Fed fund futures that show there's fingers still on the trigger finger for more hikes. And I think to myself, okay, they're going to just keep being hawkish and play that game and say inflation is too sticky until something makes them stop hiking. I think that's going to be the stock market. And I think the stock market is starting to figure it out.
Now, are you in the camp that the Federal Reserve will hike again before year end, or you think that them talking hawkishly is just because they have to talk hawkishly?
Well, both. I enjoyed that question, Gareth, because having been working for primary dealers, for those of you who don't know what those are, we used to deal U.S. Treasuries. Our job was to figure out the Fed and try to help make money and distribute that debt. And that was before we had the openness of the Fed and you had to figure out what they're going to do. I just look at very simplistically, I look at Fed fund futures. Right now, the effective rate is 5.33 and the peak is priced in for January at about 5.44. So that's not a full hike, but the key point is it's leaning towards a hike. That to me is all that matters. What you're going to hear today is so much nuance, so much discourse, so much stuff from the Fed. And the bottom line is watch those. And I think they'll stay the course. And yes, we'll stay the course. We're going to keep our finger on that trigger finger for hiking until something makes us not do it. And to me, there's one key thing, and that's risk assets going down until we get the white of the eyes of inflation collapsing, which it has started already.
So are you in the camp that a lot of the recent data that's showing inflation is because of energy specifically, or do you think it's more entrenched?
Well, here's a fact. Oh, no, it's clearly just a little bounce in CPI. What you're seeing is significant deflationary forces, a little bit of a bounce in that trend, and it's just a matter of time that it all tilts much lower. So here's a fact. The producer price index year over year low this year is minus 3.1%. That was in June. The high from 2008 was plus 9%. Yet they started cutting rates in 2007. Get the trajectory there? They cut rates because spreads started widening. Yet you look at like mortgage spreads versus treasury, it's the highest in 20 years. It's wider than that. So to me, that's part of where I'm looking for a pretty significant reset. What you're seeing is a little bounce in those lagging inflation metrics. And you look at forward-looking measures, there's a yield curve. You look at things like natural gas, the most significant measure of heat, electricity, and fertilizer. And in this country, it's dropped 80%. That's the same price as 1990. Crude oil right now, it's the same price as first traded in 2007. But there's one asset that I like to say I'm bullish on because it's just the average price this year is the highest ever, and that's gold.
Yeah. Yeah,
you and me it's just both. A matter of time that gold just breaks out higher. Yeah, I mean, exactly. But we follow what matters. Crude oil is it's spiked a little bit, but it's completely one of the world's most underperforming commodities. I love when people get bullish at it because usually it's a sign of peaks. That's what happened last year. It's certainly, here's one good little inside scoop. When I get asked by different entities, internal and external, to comment on something like crude oil, like Bitcoin in the peak in 2017, and crude oil like this week, it's usually a sign that it's over. And I was asked 4 or 5 times this week to comment on oh, Mike, you've been bearish crude oil. You're wrong. So you're seeing a spike, but within an elongated bear market. So here's the fact about the most significant commodity. It peaked in 2008. Last year, it bounced a little bit to a lower high. And since that peak, since 2008, it's made 3 lower lows. And the low this year is 63.64. That's not low enough, in my view, for a typical recession.
Yeah. And one thing I like to point out, and you just mentioned this, is that in 2008, we actually had this epic spike. I still remember vividly trading through it where we went up to about $150 on crude. And that was like in the midst of, well, it was the beginning portions of the financial crisis. But again, you look at crude and people will tell you, oh, well, crude's going up, so we can't have a slowing economy. It's going to be a soft landing. That's just not true. In fact, I would almost argue that what ends up happening where crude gets these bids before recessions is people start to rotate capital, right? Big money starts saying tech is too expensive here if we're heading potentially in. Where's the safety trade? And it's actually a lot of times undervalued oil stocks. Now they become way overvalued in my opinion, but still, I mean, again, that's a money rotation scenario.
I think you nailed it. And it's so important to have people who've been trading for at least 2 decades, at least, to give some advice from crypto people who haven't seen anything but the last 10 years. This is so significant, and that chart is so important to show. That's a bear market, right? So you show right there. That just think of that same period. If you were to tell people that the stock market was unchanged since 2007, they'd say, "Well, that's real bad." Well, that's what's happened in like Europe and Japan and China. But so that spike, though, almost every time you see spikes of this velocity, you get a recession that follows. And I think we're still getting there. But I enjoyed publishing today that the crude oil is its own worst enemy. It goes down because it goes up. Right. It's not like if you want signs of demand pull, organic demand growth, look for industrial metals. It's all copper. And industrial metals, Bloomberg Industrial Index is down 10% this year, showing significant divergent weakness. Or if you want to pull up copper, it's showing pretty good weakness. It's ready to break out. And I think that the trend is down, particularly if you figure out just see what's happening with the whole global economy tilting towards recession. And what's the biggest demand source for copper for the last 20 years? China. China is in a pretty significant economic contraction, just getting started.
Yeah, absolutely. And here, this is just an awesome chart of copper.
That's
because
good.
What it shows is this basic sideways pattern here, which is ultimately, to me, it looks like it's going to break down sooner or later here. And again, that speaks volumes to the potential of the economy. So here we are. We got about 5 minutes remaining until we get the Fed decision here. And the biggest things I'll be watching, again, for me, it's always the dollar, keeping an eye on what does the dollar do when that announcement comes out. We have seen the dollar pull back the last few days. In fact, the dollar is trading lower today. On the day. Gold, we know, is popping beautifully. So it'll be interesting to see, do those two things continue, or do we see a reversal in the dollar? And then the 10-year yield, obviously, is something to watch as well here. And let's just take a look at what the 10-year yield is doing. The 10-year yield is
right, 432.
Yeah, 432 here. Yeah, right at these recent highs. Now, you do have a little resistance here, but I still have it priced potentially. And again, I'm not sure about this, but there is a little trend line here with which we go back a decent way. That's around 460. And again, that don't know if that'll get there, but but that would be something to watch.
Man, I do enjoy being on with you, Gareth. You're bringing back memories of what I've done a lot of my career with clients and colleagues in the trading desks. And one thing I have to admit is I it's just respect you as a day trader. I so much
Thank you.
completely ignore that, having learned my lesson that it's so important that what day traders do is they help provide that liquidity in the markets and help provide the information. But I deliberately, it's on my DI list, deliberately ignore the daily moves and kind of focus on the bigger picture moves. The key fact about the dollar is right now, it's a major wrecking ball for the global economy. Just look at the yield on the U.S. Treasuries, 5.5%. That's 2 to 3 times the average yield of China, Japan, and Germany, the next three countries on the the same GDP of combined of the U.S. That's an unstoppable force for the dollar.
Wow.
And what does that do? That means every time that like China's trying to support their currency, what they do, they sell currencies, they sell treasuries. So some of that's making yields go higher. It's just a lose-lose for the global economy. And the only key thing that should typically make the dollar go down is the Fed to pivot. What's it take for the Fed to pivot? The lower stock market. So this is something I was just working with editorial. I'll be publishing tomorrow. I was just showing how the U.S. stock market divided by the rest of the world, overlaid with the dollar, is a complete direct connection, straight up, lower left to upper right since the end of 2008 and 9. Dollar starting to take off again and again. The Fed's not going to be easing. Dollar is the most expensive to short currency on the planet. It's the deepest pockets, and I just look at it as that's a train wreck that's breaking the global economy. Just look what's happening in China, in Japan, in Europe. So.
Now, just one thing that I've been watching, or I'm expecting. So the Fed decision today, we I think we both agree there's no rate hike there today. The question is, do they hike in November or December into year end? And it looks like we're just about 3 minutes away. But then what I'm watching is, are you watching Friday's Japanese central bank announcement? Do you think that's significant?
Yes, I suspect you'll be watching that more closer to me. I'll read about it, but yeah, the key thing is what's the tilt? The tilt is towards restraint. I mean, that's a big difference from Mr. Ueda now compared to before. He's really tilting towards restraint. And he has to. He's got to support the currency. The Japanese yen is plunging, and the yuan is plunging versus the dollar. This is the dollar breaking the world economy. So they have to do something. They have to do something to support the currencies. But the key thing to me for today is I watch the Fed fund futures. And the key one I'm watching is January. It's up 5 points, like 5.43 now. And I don't think that's going to change much. You need to see that start showing ease. And I don't see there's any reason for them to even signal ease until the markets make them.
Yeah. What are you thinking about, like, Jerome Powell's comments today? He's going to remain hawkish. Do you think he does? Do you think you see those Fed funds futures start to price in a hike in November or December, or you think they'll kind of stay where they are?
They already
right
are.
now?
They're like 25% for a hike in November. They've been up to as high as 40%. So here's the facts. Effective rate is 5.33. For November, the rate they're showing is 5.40. So that's leaning a little bit towards a hike. I think they're done. But why should it's just simple Fed watching for 40 years? Is the Fed's Jerome Powell's going to say what he has in the past? It's going to be there's going to be so many words, and all he's going to do is say, yeah, we're going to keep our finger on the tightening button.
Data, right?
Yeah, that's what he's going to do. I mean, it's overall, that's going to be the bottom line. And well, that's the thing. Who isn't data dependent? I always think that's kind of silly.
Yeah.
But the bottom line is their target's 2% personal consumption expenditures, employment costs index, and those numbers are running 4%. Simple fact. Until there's a credit event, until there's a pretty significant rug pull and risk assets, they're going to just stay the course. That's just usually the way it works.
Yeah, absolutely. So now we're about a minute and a half away, so we'll see what happens. But right now, I'm just looking at the daily chart of the S&P 500, and look at this trend line going back to the October 2022 lows. And again, so far this one has held. But again, that's where I would, as a trader, as an investor, if that breaks, that starts spelling big trouble, in my opinion, where you get below that. Because basically that's a major trend change, right? You've been kind of trending up, and a break to the downside, you probably get a lot of bears to pile on, or some shorting action going on.
Well, so that rally, I understand, is one of the biggest short coin recovering rallies in history. And it makes sense because of this massive fiscal pump. And my question is, I look, what's going to take it to make it difficult? But overall, I fully expect the stock market to roll over. And probably because I also look at indicators like it's like a 100-week moving average and a Russell small cap indicator. It's on the sharpest downward trajectory in like 10 years. Yeah, rates are still going up. So I look at the trends unfavorable. That might be okay, but rates are still going up. Bottom line is typical. The last two major corrections, the stock market bottomed about 2 years after the first Fed ease. I think it might be worse.
Yeah, absolutely. All right. We are just about at game time here, folks. And again, we should be having this out in just a minute, or actually less than a minute. and we'll watch the reaction. Right now, we have the markets upticking on these spiders just a fraction here. Again, very lackluster, very low volume, but let's see again what happens. And again, there'll be the statement, just so everyone's fully aware. The statement will come out now, which basically no rate hike, and then the statement, and then it's going to be his press conference at 2:30, where he really gives color to what they're looking at. Oh, here we go, guys. Markets are down just a fraction here. Markets again down ticking just a little bit, not much yet. Let's see what happens here. I still far do not have it. Do you have anything, Mike? Are you seeing anything?
Yeah, it's all the same. Fed repeats language. Fed repeats language and extent of additional policy firming. Fed gains slowed in recent. Okay, 12 officials see one more hike this year. 7 see on hold. Fed holds benchmark rate of 5.25, 5.5%. It's virtually a repeat of last month.
Okay.
And to keep the bottom line is extent of additional policy firming. It's just repeating the same language. But it's key thing to remember about the Fed is they'll watch Fed fund futures and they don't want to surprise the market unless there's a good compelling reason.
Oh, interesting. And what I'm seeing here, just so everyone's aware, oil's actually selling off a little bit here. So you got the S&P selling off, you got the oil selling off. Let's look at the dollar real quick. Ooh, look at the dollar spiking. Whoa, nice spike on the US dollar there. So that should imply gold is dropping. Let's take a look at gold.
You got that. It's already down about $5.
Now you've traded longer than me, even probably. So we both know that the first move can sometimes be the wrong move. We'll see if that's the way it is. But right now, again, Fed saying everything that they were expected to say. No hike here. 525 to 550 staying there. And again, just kind of looking over my shoulder here over the computers at a few little data points. But right now, again, nice little dip on the overall markets on an increase in the dollar. Spiders, minor support here at 441.90. You can see this little pivot low right there. That's what we're kind of into now. If we break through that, you'll be looking at the lows from yesterday as your next support at 440. But we are starting to rally back up. So let's see if we turn around and go green here.
I think it's the hour of power that matters. After 3 o'clock Eastern Standard Time, what do the money flows do? And I look at this, Gareth, something I've never seen. I started in the trading bits in '88 to date myself. Is right now the key thing is a U.S. 2-year note right now is 5.13%. That's the highest since 2007. To me, that's a massive black hole for risk assets. There is no, I mean, you can guarantee over 10% in 2 years. We have not had that in almost 20 years. And we've had this longest period in history of zero interest rates. To me, this is part of that paradigm shift towards why take all the risk of what we've had the biggest pump in liquidity and price and assets ever and zero rates when we can get 5.14% right now in that 2-year note. To me, that's the most significant thing. And that's why I think people by then they are going to do the rational thing and say, thank you very much, U.S. government. I'll take those 2-year notes and get me out of all my risk assets.
Yep, absolutely. Absolutely here. So again, Spider's still holding this little bit of a pivot here. And again, this is more day trading stuff down here where you just have this little shelf and it just right now we're holding it. We'll see if we break through it or not. But again, dipping to the point where the S&P has gone negative on the day just by a fraction. The NASDAQ 100, let's do a quick check on that. NASDAQ 100, same kind of thing, just down slightly on the day. Coming into this little shelf. Look at that. Amazing how these charts kind of, you have that little bit of a shelf right there. Price got right down there. Taking a look, oil continues to be having a pretty big, pretty nice little drop right here.
Could you pull up the IWM? That's the ETF. Yeah, now there's that's the one. I mean, small caps they've been horrible this year. What's the Russell this year? It's actually barely up.
Yep.
So small caps and what high rates hurt small caps most right away because it's harder for them to borrow.
Yeah, absolutely.
Now, I'm not trying to focus on what's bear, but oftentimes it's a leader. It lagged on the way up during COVID, but that's to me is like a bit of a bear flag.
Yeah, if you're like that's exactly what it is, and I think one of the things I've harped on to a lot of people out there is that if you look at the NASDAQ and the S&P, they've both curled up, but that again is you have the Magnificent Seven basically controlling those, right? 100 stocks in the NASDAQ, 100, 500 in the S&P. Here, the Russell is 2,000 stocks. It's your broadest index without the Magnificent Seven.
Right.
Which you're kind of your truest economics chart, if you will. And you absolutely, this is a sideways channel, which ultimately, if you looked at 100 of these, 75 or so would break to the downside. So probability definitely favors the downside here.
Well, let's look at it this way. Break to the downside depending what's the macro. Macro is the Fed is still tightening. They didn't tighten today, but the liquidity rug pull is still in the process. What happened last week? Bank of in ECB this week, Bank of England, Japan in the next day or two. It's just the bottom line is don't fight the liquidity. What do you got? Oh yeah, 2-year bond yield. There you go. What is it now? 5.14.
148. Yeah.
Yeah.
So that's continuing up, man.
Yeah.
That is continuing up. And let me just go to the 10-year real quick and just see what we got here. Speaking of just one thing I was remembering back in my really early years of trading, we were talking about Fed decisions. Do you remember where people would always joke, half jokingly, about watching Greenspan's briefcase to see if it was heavy or not?
Yes, I so enjoy it. It's so silly. But yeah, it's called trader superstition and hopium, which we all know is the worst way to trade. But you got a position on it, you get money on you on the line. You go for anything, right?
You can, and you make things up if you need to make your. All right, let me see what else is going on here. I'm just going to flip back to the spiders, the S&P. Oh, that's still coming down. So again, so far no reversal of the initial move, but like you said, I think the big thing is 230 when he starts to talk, and then all the way through his conversations, and then as the market digests it, what ends up happening here. So far, folks, I haven't taken any trades. It hasn't dumped enough on the spiders. This right here, this level on a trading basis is very high risk coming into a Fed decision.
Right.
It's not to say if we dump straight down to this double bottom here, I might be convinced to do a small trade on the spiders long, but right now there's nothing here yet, according to what I'm seeing anyways.
So it looks like we were just hitting some stops. It's coming back, but that's a great place for stops. And of course, for the conference, unless he slips up, the guy is pretty much a pro right now. He's up to Greenspan quality. He's been around, done it for a long time.
Yes.
I don't see why he should see anything dovish. And so it's just a question where and when you hit the next stops. I don't see just particularly what I'm seeing happening with yields now. I just haven't seen that that high in so long. And to me, it's just the giant sucking down, as Ross Perot used to say. And I mean, we might get a bounce in equities, but I think overall the big picture is the money flows are, from what I've heard from most money managers, is thank you very much. I'll take that to note.
Yep, there you go. Absolutely. So let me see here, and I know it's hard to see on the screen that you have the wick down here, but
it's great. I can see it very easily.
Oh, okay, good.
I really appreciate you doing this. I love how it's like you're reliving a lot of memories here for me.
Yeah, man, that's awesome. Let's look at the dollar again, just quick. Yeah, dollar's pulling back a little bit, but that's one heck of a pop on the dollar. I mean, you basically jumped vertically to 105.20 on the Dixie here. And interestingly enough, kind of the same thought process is if you're asking where I would see resistance on this chart, through all these pivot points, and look at where it went. I mean, just right to the almost penny.
So I'll give you a little preview tomorrow when I'm done today. My headline is the Dow is becoming the giant wrecking ball. The Dow is swinging harder, and I like to ask the question, what stops it? And I think it's going to take the U.S. stock market going down to stop the Fed from keeping this. I mean, the disparity between just U.S. and China right now, it's almost 300 basis points in a 2-year note yield. That's the high since 2006. So you look at the second largest economy on the planet, net exporter, I don't see any type of that engine of economic growth is potentially imploding. Dow is just making it difficult for everybody.
Yeah, 100%. I agree. Now, are you in the camp that we'll see a pullback in oil in the near term now? So you think oil's kind of topped?
So I know, I when I'm wrong, it stopped out. I didn't think it would get much above 85, and here we're 90, got to 91. It might even get to 100. We're talking WTI. You got WTI in there. I think oil's going to $40 a barrel. Now, I've said that early. I've been wrong. I've taken a lot of hit for it. But the low, I did say it when I was pushing, when people were looking for 150 last year deliberately, and the low this year, 63.64 in WTI. So it was way oversold. Managed money net positions were really short. I don't know if you watch this, but right now, managed money net positions are really long. Hedge funds are way long. To me, that's the key thing about oil. It's creating part of this reason that we saw the Fed still on the trigger finger for heightened with that inflation still going up. It's its own worst enemy. I think it's going to $40 a barrel. in a normal recession, and our Bloomberg economics team thinks that's 100% in the next 6 months. Yes, they've been early. Yes, we've been wrong. But what's happened since then? I mean, their model started showing this a while ago, and this year we still hiked rates another 100 basis points. But key thing about oil is, bottom line is the thing that's pressure oil for the last 10 years is the massive excess of the supply in North America and Canada versus demand. OPEC is less significant anymore, and China, the demand source, is starting to trickle, starting to, the dominoes are starting to fall downward to China.
What are your thoughts on Bitcoin in terms of? I mean, you're a long-term bull, bearish, short-term kind of.
Long term, you have to be bullish something like this revolutionary asset with declining supply and increasing demand and adoption. But my base case for Bitcoin is that it's the world's most significant leading indicator, and I think every risk asset's going to go down, particularly the stock market. And Bitcoin is still going to be that leading indicator. And at some point, it's going to tip over and trade more like bonds and gold in a recession. But I'm so fearful it's going to break down now. And the key thing, remember, that what's happened this year is every risk asset's gone up, but Bitcoin on a risk-adjusted basis is still trading very poorly. It's not doing well in 3Q, and to me, it's tell me that everything is going to go lower. So I think it's at greater risk of kind of revisiting those lows, maybe even take out the lows around 15. And at some point, I do think it's going to go back to that big picture, long-term pattern. But here's the macro about Bitcoin. It's the best performing asset in history. And in a period, we've had the period of the lowest interest rates ever, unprecedented. And okay, it did well, but the facts have changed. I get that 2-year note, 5.13% right now. 2-year note, facts have changed. So if Bitcoin can be a leading in, if it's still leading indicator, I think the risk is it goes down first.
Are you thinking that? Yeah, I'm in that same camp, and ultimately I'm even in the camp like you are, that we could even retest 15,000, even maybe pierce that. And my base case for that, or my situation for that, would be if you saw a 30-40% drop in the Nasdaq. How does Bitcoin withstand that kind of decline because of panicking? Now, eventually, I do think it's it's kind of the digital gold, but I just don't think it's at that maturity level just yet.
Yeah, there you go. Well, here's also a key thing you and I learned very early, Gareth. If it seems that easy, something's wrong. In this narrative that, it's going to go up because ETFs will launch, is just so too simple. I mean, I've been expecting these things for 5 years when we first launched the Bloomberg Galaxy Crypto Index. It's just a part of when it's going to happen. But it's still the world's most significant leading indicator. Remember, it trades about volatility to almost 3 to 4 times in Nasdaq. And my base case is stock markets go down in recessions. We haven't started it. The Fed has even started easing to help alleviate when stock markets go down. And typically, the last 2 corrections in the S&P 500 was peak to trough 50%. So this right now is just the noise. A couple months from now, that should be starting, and Bitcoin is a prime candidate to kind of lead the way. Now, it's had a nice bounce from 25, but it's got to at least sustain. It's got to show me divergent strength versus either weakness in the stock market or outperform the stock market, and it hasn't been doing that.
Absolutely. And I also think, like you mentioned, the spot ETFs, like the bulls are kind of hanging on to that. And I'm a huge long-term bull on Bitcoin, but I'm also a realist, and I've been made a realist because of all the losses I've taken early in my career, trying to, figure out the narratives and going with those as well. But I think also the other thing that bothers me is everyone's like, I've been told so many times, buy Bitcoin now because the halving's next year and it's guaranteed profits, right? And it's just like, man, I thought, I can't tell you how many trades in my early career I thought it was a guarantee, and I always lost money on those.
Benjamin Disraeli said, what we anticipate generally doesn't happen. And that has been the most, your average 6-year-old gets it. It's just, here's a good narrative. At the beginning of this year, end of last year, the complete consensus was China reopening is going to bid up the price of crude oil. Completely didn't happen. But that was consensus from the top streets on the firm. Now, the consensus for Bitcoin is, particularly for those who've been long and made a lot of money and are long or have holding bags, is, all this is going to be bullish. They're all known knowns, and it's the unknown knowns that really matter. And halving has really not made a difference. It's just a good indication that supply will decline over time, which is part of the reason you and I are long-term bullish. It's part of the reason gold goes up over time over every fiat currency on the planet, because gold supply is limited and currency supply is unlimited.
Yeah, absolutely. Absolutely. Now, what are your thoughts, about the GDP? So I'm reading Fed GDP forecast more than doubled for this year to 2.1%. I've also seen, I think it's the Atlanta Fed that was pricing in something like 4 or 5% GDP in the last quarter of the year. I mean, is that reality? I mean, what's going on there?
I've been showing a lot of stuff with GDP lately. and pointing out that if you overlaid the stock market versus GDP, before the Fed started tightening, it was the highest since 1937. So there's a lot of nuances there as far as the actual number, 2-3%. This is ex inflation, nominal. I'm sorry, not net GDP. That's going to be. To me, it's such a lagging thing. In predicting it, it's the leading that matters. But what I like to point out is when people point out to say, "Hey, Mike, why are you bearish the stock market?" I say you have to use the Warren Buffett model, and I used to use the Dow and versus GDP just about a year ago. It was the most expensive ever. So that's why I rope in GDP. And then I like to point out things with related to GDP's ex inflation. What I enjoyed recently when we had the inflation number, CPI, PPI last week, and retail sales ex CPI is negative for the most significant period since the great financial crisis. If you take out inflation, retail sales are deflating and the Fed's still tightening. If you do the same thing in Europe, retail sales are negative and ECB is still tightening. So GDP to me is kind of a noise number. And I fully expect we're going to have significant contraction in a deflationary environment after this big pump that typically just reverts back the other way.
Now,
just a question of when.
So we see what the Fed's doing. We'll see what Powell says in a little while. But where aside from gold, obviously, you're a fan of gold. Is there is it worth investing in any foreign markets? Like where could people go if they don't want to invest in the stock market or they want to limit their U.S. investments in the stock market?
Well, yeah, so that's where I have to be careful. I don't give investment advice. I don't really focus too much on the rest of the world. But to me, I will say the most compelling thing I've ever seen in my lifetime is this U.S. government 2-year note at 5.13%, or just 5-year note, 1-year note. That whole sector, you can guarantee 5% a year, annualized. And virtually, like my father is an octogenarian. Here's a good example. I talked to his manager, and he had 1/3 of his money in the stock market. I'm like, are you insane? he's almost 9 years old. The average sentiment of your average human being has not shifted over yet to the facts have changed. The easy money that we've had the last 20 years, the Fed would ease every time the stock market went down 20%. That's a fact since about 1950 is over. Yet you don't have, there's an alternative, and that's U.S. Treasury. So I look at that as that's part of the problem with the dollar. The dollar is going to be just too strong until that changes. It's part of the problem with the stock market, all risk assets, with housing, any type of risk asset. It's just that compelling. It's the black hole of money going into that high riskless security, high yielding riskless security.
Wow. All right, so here we are, right? So the S&P is just hugging this line. We got basically a minimal sell-off. Dollar did pop. We saw gold come in a little bit. We saw yields inching up a little bit. Oil's falling back in. But again, S&P down into a little bit of support here. The question again is, does it reverse on the Fed, or do we see a flush through this technical level? And I think that's going to be the big one. I'm going to look through a few of these questions and just we'll finish up with just a few of these questions, guys, that you guys are asking. I appreciate the kind words, by the way, and thanks again to Mike McGlone here for jumping on. Just by the way, make sure to follow him on Twitter. Are you on any other? Are you on YouTube? Do you have any YouTube?
Twitter and LinkedIn, main ones.
Twitter and LinkedIn.
The main thing is I publish on Bloomberg, so that's trickle down stuff for me. Twitter and LinkedIn.
Cool. Yeah, no, and I followed your stuff for a long time. I see it pop up on Twitter daily, and it's always good. I always look into it and read it. It's very cool stuff. So I think let's do this. Let me just look. I'm looking through a couple questions. If anyone has any, type them in real quick, and we'll do our best. Maybe answer 5 questions. A lot of you guys are just talking about what you guys are liking, and some other kind words. Seems like Mickey's saying, seems like everything is upside down, like time has stopped. Yeah, and honestly, it's kind of like that, right? I mean, everyone's now waiting for Jerome Powell. I mean, he's the man of the hour, essentially. He'll be coming out in just a few minutes and giving his speech.
It's going to be, and it's the way I look at these kind of things, he's very unlikely going to say anything away from the general narrative, but the market will look for what it's looking for. Like Jesse Livermore says, the market will always do what it's supposed to. It's just a question of when, and it might not happen today. It's really, I really focus on the weeklies, and oftentimes I kind of ignore the movements today. But for day traders, this is where you help, create the liquidity in the narrative. But my lesson is I like to pull back and just watch and let markets trade. And it's also, having been in the trading pitch, the essence of, buy, 1 bit of 2, 3 bit of 4, the essence of day trading. It's just a lesson I've learned. It's nice to sit back and watch the whippersnappers play.
Yeah, absolutely. There you go. Last thing, or one of the questions I'm seeing is natural gas, right? And so natural
Yeah.
gas to me, it makes sense that we could get a breakout. Not only does it eventually usually track oil, I mean, usually it lags and then it kind of catches up a little bit. What are you seeing anything in the chart that kind of signals one way or the other on natural gas?
Perfect chart. I love that chart. So one thing about natural gas is it is the most um, is the leading. It's the most significant in benchmark for heat, electricity, and fertilizer in this country, and it's collapsed this year. It went from 10 last year, the high, to 2, and we create more of it with less every day, yet we use a lot more of it too. So I look at natural gas as crude oil is more likely to follow that lead of natural gas. It's bouncing now, but it's that seasonal. Natural gas is very seasonal. So if you have to look at the curve. So you look out to DC gas, which or Jan, which look at the Jan gas is around 355. The current's 273. That makes sense. But it's the 1 year spread I always like to watch. So OCC 23 is 270 right there. Let's look at OCC 24 is 335. So it's still showing some normal contango. And I think it might hit 3, it might hit 4. But overall, the key thing to remember about natural gas is that pump last year was significant. It almost always has an enduring dump period. My natural gas team in New York says we're kind of pulling back on the where the reserves aren't as much, part for good reasons, because last year was great incentives to produce more of it. This year there isn't because prices are lower. But overall, just remember, natural gas has dropped 80% from its peak last year down to 2. Now it's just kind of fluctuating in a range, and it might trade between 2 and 4 for years. But the bottom line is the price you see in that screen there just a few days ago was first traded in 1990. Imagine if we said that about any of the stock market.
Amazing. Amazing. All right. So that answers a couple of you guys' questions on natural gas. I saw a couple questions on the semiconductors. Has NVIDIA really broken down? And for me, this is my chart on NVIDIA, right? Very clear little channel. And we're right at the lower end here. So the first thing I think, and Mike and I have been around for a long time, is that when they had earnings, it was amazing earnings. There's no question about it. But always remember, things top on amazing news, right? They bottom on horrendous news and they top on amazing news. And that really was the top on NVIDIA. I remember pre-market or after hours, it even traded as high as this 520 level. And here we are. But it is technically at this longer term support. If it breaks, that's where, again, the floodgates could open. And I think for me, NVIDIA has become a indicator. It used to be Apple. Now I actually watch NVIDIA as the leader for the stock market, for the NASDAQ, I should say.
I appreciate you mentioning that. Maybe I should do that more. I mean, tremendous indicator and tremendous wisdom. Our listeners need to hear this. Markets always peak and massive enthusiasm. And you and I remember Cisco. I don't think it ever got above that high. To me, it's just a complete repeat of that. I remember hearing about AI when I was an undergrad in the 80s, early 80s. I'm like, okay, it's nothing new. It's just accelerating. But yeah, very good leading indicator watch. And to me, it's like RCA was in the 29 before the 29 crash. It went from like 8 to 300 and then back down to like 8. This is just how things work. I mean, it's how many times earning is it right now? Was it 200, maybe 150 times earnings right now?
Yeah.
Like, okay.
I mean, you know, and the thing is, if they keep up their growth and their margins, which were ridiculous, then sure, you could justify it. But I always say to people is like, just like with Tesla in 2021, you know, the Tesla vehicle was amazing. It is amazing. But all the other car companies were licking their lips looking at Tesla, and they said, we're going to make EVs. And every semiconductor company right now is looking at NVIDIA saying, we need to make these AI chips. And so it's going to inevitably crush margins. And that's where the price is going to have to come back down. Doesn't mean it has to do it on an intraday or a daily basis, but over time it will come in. So good question on that one. Let me just see if there's one more to quickly answer here as I'm just kind of popping through some of these. We talked about Bitcoin. We talked about nat gas. The only thing I'll say here is I do, and again, I'll throw out a little bit of my trade thought process. If I'm correct and oil is starting to come in here, then for me, I'm short a little oil. There's no doubt about that. But for me, it's looking at trades that have been crushed by high oil. And I'll just throw this out. And these are swing trades, mind you. But keep an eye on something like the ETF that tracks the airlines, right? The jets. And again, I do not have a position in the jets right now, so just be aware of that. But look at the fall. And if you put that up against the oil chart is basically inverse. And so if you want a way to play a fall in oil, it might be to look for a short-term move up in the airlines. And again, you could go to LUV or AAL. Long term, I'm in the camp of just a recession, so I don't think long term I'm in love with them. But shorter term, a lot of these have been beaten down. So just a little tidbit from me there. I don't know if you have any comments on it, Mike, but
I appreciate the mention. I want to say one thing that I really appreciate is I try to always look at it as I don't trade anymore. It's so delightful I don't. I'm a horrible trader. As a boss said to me once, I say it better than I do it. I would have been, and I was trying to think of what I've been done. I would have been stopped out on crude oil already, or my put ratio spread would have been decaying, and then I would try to be resetting it. But that's how trading is. You can always pick the lows and the highs. You want that 70% between. So I'm impressed you've been able to maintain that short. I don't know how long it's going to last, but I think ultimately crude oil doesn't bottom until it gets cheap, and cheap for the last 40 years has been around $40. Yep. And I think it's going to get really cheap because of what's happening with the paradigm shift. One simple fact is unleaded gas in this country is 5% below when it was before COVID. And what is that? Why? There's so many reasons for that, but it's just this country. But crude oil is such a great thing. It's one thing to always remember about crude oil. It goes down because it went up. That's one way to remember it. It goes up because it went down. It's so autocorrelated. Just trade the swings, and just from 90, I think it could drop 50%. But it's to rally 50%. Imagine what that would do for the global economy.
Oh my goodness! Yeah, incredible.
Yeah.
Very nice. All right, so we have the S&P is inching back up. That to me implies that the dollar is pulling back a little bit. You can see the inverse relationship. Same. So 2 red candles down. We've got 2 green candles forming on the 10-minute chart of the spiders. That inverse relationship is always something important to understand. And on that note, I think that'll be it. I mean, people can watch the Jerome Powell comments on their own. But Mike, dude, thank you for joining me. And guys, tomorrow at 3 p.m., Mike's going to join me and Scott Melker. We're going to be doing Market Mavericks, a new show that we're debuting tomorrow. So it's going to be awesome. I can't wait to get the 3 of us together and see what crazy ideas we can throw out there.
Thank you, Gareth. It's going to be fun, and I appreciate you having me.
Thank you so much, Mike. Have a good one. Take